How's it going, everyone? My name is Dan, but you can call me Malone, and over the past 6 weeks I've been studying hard for my tax exams, which I sat last week. But when I was studying for the exams, an idea came to my head for a video. I thought to myself, the people of Ireland want to see a video which shows them how to pay less tax. Because let's be honest, we pay enough tax as it is, and most of us don't want to be making any extra contributions to the exchequer out of the good of our hearts. So with that being said, in this video, I'm going to show you 3 ways that you can avoid paying tax legally in Ireland. I get asked all the time, Dan, why don't they just teach us about tax in school and then we'd all be in the know? I definitely agree that tax should be taught at secondary school level. However, the tax system and tax law is complicated and detailed. In fact, I can actually show you the tax legislation books which cover taxes such as income tax, corporation tax, capital gains tax, capital acquisitions tax, stamp duty, and value added tax. And as you can see, there are many different rules governing various tax treatments of different scenarios. Having to pay tax is the end result of the rules contained within those books. However, just like how there's rules which say that you have to pay tax, there's also rules which say that you don't have to pay tax or have to pay less tax in different scenarios. That concept is the basis for today's video, and it's very important that you understand it. So without further ado, let's get started. Number 1, pensions. The first way that you can avoid paying tax legally in Ireland is through a pension. Now I know what you're thinking, Dan, pensions are for old people. I'm in my 20s. Surely it's far too early for me to be thinking about them. This is a very common misconception which exists simply because people don't understand pensions, what they are, and what they can allow you to do. To very briefly recap on pensions, a pension is simply an investment fund. You invest money into your pension, and depending which investment funds you've selected, your money will be invested into the likes of stocks, bonds, property, and other financial assets. Pensions are important because they'll likely be your primary source of income in retirement, i.e. when you stop working and stop earning a salary. So where exactly does tax come into all of this? Well, believe it or not, the tax system and pensions are interconnected. Pensions are the byproduct of tax law, which is introduced by government and monitored by revenue. And pensions are interesting because it's one of the only tax policies which encourages saving over consumption. We've discussed in previous videos how the government used the tax system to encourage or disincentivize certain economic activities depending on what the needs of the country are at that time. So why would the government want you to save and invest for retirement? Well, because if you have your own nest egg to support you in retirement, it's less likely that you'll become reliant on the state for financial support, which will be costly to the taxpayer. So therefore, it's in the government's best interests and the interests of the Irish people to offer tax incentives for investing in pensions. So how is this done? Tax relief is given to you, the investor, in 3 stages when it comes to investing in pensions. The first stage is tax relief when you invest in a pension. This can only be described as free money in your pocket, and if you can wrap your head around this concept, you'll start to understand why pensions can be so powerful. Let's say we have a worker called John who is 28 years old, and John earns a salary of €60,000 each year. The 2 things that are important there for pensions are John's age and his salary. The tax code states that John can contribute a portion of his salary each year to a pension fund before any income tax is charged to that portion of his salary. The portion of his salary that John can contribute to a pension fund tax efficiently in any given year is determined by reference to his age. You can see from the table on screen that as you get older, the percentage of your income that you can contribute tax efficiently to a pension scheme increases. And this makes sense because as you near retirement, the government are trying to incentivize you more and more to save and invest. In our example, John is under the age of 30, which means he can invest up to 15% of his salary in a pension fund in any given tax year without ever suffering income tax on that portion of his salary. This comes out to €9,000, being his salary of €60,000 multiplied by 15%. So John can invest up to €9,000 into a pension fund for the benefit of his future self and suffer no income tax on the €9,000, i.e. the full €9,000 goes into the fund for his benefit. Now let's imagine that John didn't invest the €9,000 in a pension fund. Ignoring USC and PRSI, John's employer would deduct 40% income tax from the €9,000 before John ever received it into his bank account. John would receive €5,400 into his bank account after tax, meaning that €3,600 in tax has been paid over to revenue. So by choosing to invest in a pension fund, John is effectively receiving a free €3,600 that is invested for the benefit of his future self. Because remember, if John chooses to not invest in a pension fund, he'll only receive €5,400, meaning that €3,600 is paid to revenue in tax. So John would never have that extra €3,600. By definition, this is literally free money that anyone can avail of. Now, most people at this point say something like, well, it's not really free money because it's being invested and I can't access it now. This is a psychological barrier that many people struggle with. The idea that it's hard to make sacrifices today for the benefit of your future self who you don't really identify with. But there's no denying that by actively choosing to not invest in a pension fund, you're giving up free cash, you're paying more taxes, and you're missing out on the long-term benefits of tax-efficient investing. The second stage of tax relief comes when your money is actually invested in a pension. Any dividends or interest that your investments generate are completely tax-free within a pension and are reinvested for your benefit. As well as this, any gains on the sale of investments within a pension fund are also completely tax-free. Essentially, what this means is that the investment returns that your pension investments generate are not taxed, which allows them to grow at a much faster rate than any other comparable investment. And if all of that wasn't good enough, when you do eventually reach retirement, the tax code will allow you to take a portion of the total value of your pension fund as a tax-free lump sum. Long story short, pensions are the absolute best way to legally avoid paying tax for the average Irish person. Not only are you paying less tax, but you're also making moves to secure your financial freedom in retirement. So it's a win-win situation. On the topic of investing, the second way that you can legally avoid paying tax in Ireland is to practice tax-efficient investing. We've just discussed the number one tax-efficient investment available, which is a pension. However, there are things that you can do in your own personal investment portfolio to minimize your tax bill. First of all, buy and hold for the long term. In Ireland, for the most part, only gains which you actually realize by selling the investment for a price higher than the price you paid for it are taxed. Meaning that when your stock investments are in the green, they won't be taxed so long as you don't sell. This is one of the biggest issues associated with day trading, because not only are you incurring large amounts of transactions fees by constantly buying and selling, you're also building up a big capital gains tax liability on your realized gains. Second of all, if you're trying to minimize your tax exposure, then don't invest in dividend paying stocks. This isn't something that I necessarily recommend, but by not investing in dividend stocks, you're not receiving passive income and therefore no tax liability will arise. Whereas if you receive dividends, those dividends will be liable to income tax, USC and PRSI, and you'll be required to pay this tax and file the associated tax return. Lastly, invest in ETFs. I made a full video on the channel discussing how ETFs are taxed in Ireland, and because ETFs are becoming a staple investment in nearly every investor's portfolio, I highly recommend that you check it out. ETFs generally get a bad rap from a tax perspective in Ireland, but at the end of the day, they represent a low cost and diversified investment product which allows access to tax-free investment growth for a period of 7 years. Yes, the tax rate on ETF gains is 41%. But don't jump to any conclusions that automatically makes it a worse investment as compared to stocks. Check out the ETF video and then make your own conclusions. The third way that you can legally avoid paying tax in Ireland is to have good knowledge of tax reliefs. Now look, as we've seen at the start of the video, there are lots of different rules and regulations contained within the tax acts, and no one is expecting that you have a detailed understanding of everything that's in there. From the perspective of selling investments, the best reliefs available to minimize your capital gains tax liability will be the likes of retirement relief and entrepreneur relief. However, the average investor who just owns a couple of shares in a company is not going to be in a position to satisfy the requirements of these reliefs. They're more so geared towards the sale of shares in a company that's set up and owned by the individual selling the shares. That's something you need to realize about tax law. A lot of the reliefs available in the tax code are totally dependent on the facts and circumstances of the situation at hand, meaning that there aren't a whole pile of blanket tax reliefs that anyone can apply to drastically reduce their tax bill, with the likes of pensions being the exception. However, if we take investments for example, there are things available such as the annual capital gains tax exemption of €1,270, whereby the first €1,270 of gains in any tax year are exempt for CGT purposes. In a similar fashion, you have the likes of the small gift exemption for capital acquisitions tax, whereby you can receive up to €3,000 in any calendar year from any person without having to pay tax. So being aware of annual exemptions is helpful when structuring transactions and minimizing your tax bill. You can also claim tax back on health expenses, including but not limited to GP visits, prescription medicines, and non-routine dental care such as crowns and root canal. The value of the tax back will generally be 20% of the value of the expense, and it can definitely add up, especially if you're spending a lot on health expenses. Tax back is also available on tuition fees paid for third level education. In this case, the maximum fees that you can claim relief on is €7,000 per course, with the first €3,000 of fees for full-time courses being disregarded for tax relief purposes. You then get tax relief equal to 20% of the remaining excess. Let's have a look at an example of how this works. John pays tuition fees of €5,500, the student contribution of €3,000, and a student levy of €247 for a full-time course. The total qualifying fees in this example are €8,500, with the student levy being ignored. However, as we mentioned, the maximum qualifying fees for tax relief are €7,000 per course. Therefore, the €8,500 in fees here is restricted to €7,000. The first €3,000 is then ignored, leaving €4,000 remaining in qualifying fees. Tax relief is then calculated as 20% of this amount, equaling €800. One other very useful relief available to investors is the Employment Investment Incentive, or EII. If you go onto the likes of sparkcrowdfunding.com, you'll see lots of startup companies who are looking to raise equity investment. If you click into the details of their campaign, you'll see that it says EIIS in the top right hand corner. What this means is that the company is a qualifying company for the purposes of the Employment Investment Incentive. If you invest in these companies, you'll receive a tax deduction for income tax purposes for the full value of the investment, subject to limits. This can represent a potential 40% tax saving, similar to how pensions provide tax relief on initial investment. Now, obviously the risks associated with startup investing are much greater. However, it is possible to avail of EII tax relief via a designated investment fund, who will spread out your EII investment across many different companies included within their portfolio. So those are some of the ways that you can legally avoid paying tax in Ireland and reduce your overall tax bill. As I said, the tax code is extremely dense with lots of rules, exceptions to the exceptions. You get the picture. But generally speaking, if you're aware of the power of pensions, you're aware of what investment activities give rise to a tax liability, and you're aware of the various annual exemptions and reliefs, well then you should be in a very good spot to effectively manage your overall tax bill. Good tax advice is certainly worth its weight in gold, and if you are unsure of any of the information that you've heard in this video, I highly recommend that you reach out to a chartered tax advisor for a consultation. Everyone's circumstances are unique, and so it's best to gain peace of mind and clarify your assumptions as to what tax exposure you might have, if any, when it comes to a given transaction. As always, the information contained in this video is for entertainment and educational purposes only and isn't meant to constitute advice. But if you did enjoy today's video, don't forget to leave a like and subscribe, and I'll see you in the next one. Cheers.